While you are shopping around for a home of your dreams at a high interest rate market, you may see some homes marketed as assumable mortgage rate at 2.75 or 3%. And you may think, oh, that's wonderful, I will go ahead and assume the mortgage, but what does it really mean? Let's dive into it. An assumable mortgage is a type of home loan that allows the buyer to take over or assume the seller's existing mortgage. An assumable mortgage lets the buyer inherit the interest rate, repayment period, and other terms of the seller's original mortgage. This can be beneficial if the existing loan has more favorable terms than what the buyer could obtain on the current market, but there are some downsides to be aware of. So let's talk about the types of assumable mortgages. Government-backed loans such as FHA, Federal Housing Administration, and VA, Veterans Affairs loans, are typically assumable. Conventional loans are less commonly assumable but can be if the lender allows it. The buyer must apply and be approved by the lender to assume the mortgage. Proper legal documentation is required to transfer the mortgage, and there may be fees associated with the assumption process, including processing and administration fees. Now, as far as the benefits go, it has lower interest rates, obviously. If the seller's mortgage has a lower interest rate than current market rates, the buyer can save money on interest payments. And another benefit for assumable mortgages is its reduced closing costs. Assumable mortgage can lead to lower closing costs since there is no need to secure a new loan. Now let's talk about the drawbacks. The first and most important thing is down payment. The buyer must often make a substantial down payment to cover the difference between the home selling price and the remaining balance on the mortgage. So for instance, if the selling price is $100,000 and if the remaining balance is $80,000, now the new buyer has to make a $20,000 down payment in order to assume this mortgage. Another drawback is qualification. The buyer must still qualify for the loan under the lender's criteria, including credit score, income, and debt-to-income ratio. Also, some mortgages have due on sale clause, which means the loan must be paid off upon sale of the property unless the lender waives this clause. When considering an assumable mortgage, buyers should take into account several important factors to ensure that it aligns with their financial goals and circumstances. For instance, interest rate comparison. Compare the interest rate of the assumable mortgage with the current market rates. If the assumable mortgage has a significantly lower rate, it can lead to substantial savings over the life of the loan. Qualification requirements. Buyers must meet the lender's qualification criteria. Ensure you have a stable financial situation to meet the lender's requirements and avoid future financial difficulties. The most important part for me is down payment and equity gap. Be prepared to cover the difference between the home's purchase price and the remaining balance on the assumable mortgage. This gap can require a significant down payment. If you don't have enough funds for the down payment, consider whether you'll need to secure additional financing and the terms of that loan. And obviously, loan terms and conditions. Understand all terms of the existing mortgage, including the remaining loan term, any adjustable rate provisions, and prepayment penalties. Verify whether the existing loan has a due on sale clause, which might require the entire loan balance to be paid off upon transfer unless waived by the lender. And the other part to consider is fees and closing costs. Be aware of any fees associated with the mortgage assumption process, such as administrative and processing fees. While assumable mortgages are often lower than new mortgages, there may still be closing costs that need to be paid. Ensure that all legal documentation is properly handled to transfer the mortgage and protect your interests. Confirm that the seller is released from liability on the loan to prevent any future complications. Assumable mortgages can be a strategic option in certain real estate transactions, benefiting both buyers and sellers under the right circumstances. Taking these considerations into account can help buyers make an informed decision about whether an assumable mortgage is the right choice for their particular situation. Contact us if you have any questions about assumable mortgages. See you in the next one.